Taxes can be one of your biggest expenses in retirement, and most Canadian retirees end up paying tens of thousands, sometimes hundreds of thousands more in taxes than they need to over a 25 or a 30-year retirement. The reason? They're withdrawing from their accounts in the wrong order, at the wrong time, and they're missing strategies that could be saving them thousands of dollars every single year. Today, I'm going to walk you through 5 tax planning strategies that, in some cases, can save retirees over $100,000 throughout retirement. Hi, I'm Stefano Francesca, Certified Financial Planner Professional and Senior Wealth Advisor at Next Step Wealth Management with IPC Securities Corporation. In this video, we're talking about retirement tax planning, the strategies that can help reduce unnecessary taxes throughout retirement. And here's what catches most people off guard. These aren't complicated strategies or loopholes reserved only for the wealthy. They're CRA-approved approaches that any Canadian retiree can use. The problem is, most people simply don't know they exist until it's too late to implement them properly. If you find this helpful, don't forget to like and subscribe. It really helps more Canadians see this. If you're married or in a common law relationship, income splitting is one of the most powerful tax reduction tools you have, but only if you've planned for it properly. And most couples haven't. Here's how it works. You can split up to 50% of eligible pension income with your spouse at age 65. That includes RRSP withdrawals. So if one spouse has significantly more retirement income than the other, you can shift income from the higher earner to the lower earner, which moves that income into a lower tax bracket and can help reduce your total household tax bill. It's an election you need to make each year when you file your tax returns. The issue is setting things up properly so that you can map out and take advantage of income splitting correctly. Let me show you what this looks like in real numbers. Robert and Linda are married. They live in Alberta. From ages 60 to 64, Robert has most of the income, a small pension, RRSP withdrawals, and Linda has very little. So Robert is paying tax at a higher marginal rate while Linda's tax rate is low. She's already receiving some pension income split, but not the RRSP income just yet. So Robert keeps taking income at 30.5%, while Linda still has plenty of room in her lower tax bracket of 22. That's more than 8% difference. At age 65, they start income splitting. Robert shifts a good chunk of his RRSP income to Linda in order to fill all the income in her lower tax bracket. Now Linda is paying tax on that income at her much lower rate, and their total household tax bill drops. But here's where most couples run into trouble. If you're retiring before age 65 and one spouse has all the RSPs while the other has nothing, you're going to face a challenge from age 60 to 65. You can't split RRSP income until you're 65. So if all the money is in one spouse's name, that spouse may be paying higher taxes for those first 5 years in retirement. This is where you need to be proactive, and making an election on a tax return won't fix the issue. Setting up the right structure well in advance of retirement does. The solution is to start spousal RRSP contributions years before you retire. Make sure both spouses have retirement accounts. That way, both of you have income sources before age 65, and then you can maximize income splitting once you turn 65. Just be really careful about attribution rules here. This is planning that needs to happen well before you retire, not the year you're walking out the door. Most people think of their RRSP as their primary retirement savings vehicle. And for accumulation, that makes sense. But in retirement, your TFSA becomes the most strategically important account you have. Why? Because big expenses don't stop when you retire. You're going to need a new car at some point. You might need a new roof. There are going to be emergencies, medical expenses, family situations, unexpected repairs. And the question is, how are you going to pay for those without triggering a significant tax bill? Let's introduce you to Margaret. She's a single retiree. In one scenario, she's taking the minimum from her RRSP, using her TFSA to top up her income, and by age 70, her TFSA is completely depleted. She needs $40,000 for a new car. The only place she can get it is her RRSP. At a 25% marginal tax rate, she has to withdraw over $53,000 from her RRSP just to net $40,000 after tax. In reality, due to withholding tax rules, she would have to redeem just over $57,000 just to get the cash, then wait until taxes are completed to get some of that money back. But with an extra $57,000 in income, she's probably jumped into a higher tax bracket and that refund is getting chipped away. That's at least a $13,000 difference for a single expense. In the second scenario, we've done some strategic planning. We've been more aggressive with her RRSP withdrawals early on, bracket sizing her taxable income, and more conservative with her TFSA. By age 70, she still has $42,000 in her TFSA. She needs that same $40,000 for a car. She withdraws it from her TFSA, zero tax. She keeps her RRSP intact and avoids the tax spike. So here's what this means for you. If you're 5 to 10 years away from retirement and you've been focused exclusively on your RSP because you're a high income earner, start shifting some of that focus to your TFSA. Build it up now, because once you're in retirement, having a well-funded TFSA can give you tax-free flexibility for the big expenses that are inevitably going to come up. And if you're already retired and your TFSA isn't well funded, you may still be able to address this depending upon your tax bracket. You can consider withdrawing extra from your RRSP, more than you need for spending, pay the tax, hopefully at a low rate, and contribute the after-tax amount to your TFSA. You may be creating future tax-free flexibility by paying a bit more tax now, but you have to run the numbers. This one is simple in concept, but critical in execution. When you look at your retirement income plan, your average tax rate should stay relatively level throughout retirement, ideally within 2 to 3% a year over year. What you don't want is a roller coaster. You don't want years of zero or very low tax early in retirement, followed by years of potentially significantly higher tax later on. If you see that pattern in your plan, that's a red flag. Here's a scenario I see frequently. A lot of retirees come into retirement with cash, maybe from a severance package, maybe from an inheritance, maybe just savings that they've accumulated. And they think, I'll live off this cash for the first few years. I won't touch my RSP. I'll keep my taxes low. And on the surface, that sounds smart, but here's what can happen. You create years where your taxable income is embarrassingly low because you're spending after-tax cash. Then the cash runs out. Suddenly, you may be forced to start drawing more heavily from your RRSP. Your taxable income could spike. Your tax rate might jump significantly. You've gone from almost no tax to a potentially significant tax burden. The better approach? Don't front load all of your low tax years. Consider drawing from your RRSP even when you have cash available. Use that cash strategically, maybe to top up your TFSA, maybe to cover expenses for while you're drawing more from your RRSP. But keep your taxable income, and therefore your average tax rate, more consistent throughout retirement. In Margaret's case, when we built a proper withdrawal strategy for her, her average tax rate stayed around 14 to 15% from age 60 all the way to the point where her RRSP was depleted. It didn't spike, it didn't drop to zero, it stayed level. And that consistency meant she may have been paying closer to the minimum tax required year after year without creating avoidable challenges down the road. If your retirement plan shows years of zero tax early on, that may be a warning sign worth addressing. If you're within 5 to 10 years of retirement and you want to make sure you're not overpaying taxes throughout your retirement, click the link in the description to book a consultation. We'll walk through your income sources, your investments, your withdrawal strategy, and show you exactly where you might be leaving money on the table and how to fix it before it's too late. This is the strategy that tends to have the biggest impact, but also the one that requires the most planning and coordination. The idea behind the RSP meltdown is simple. Draw down your registered accounts, your RRSP, your LIRA, as quickly as you can while staying tax efficient. Underline tax efficient. Now, many people are either too conservative or too aggressive with this strategy. They take CPP early at 60 or 65, and they take only the minimum required amount from the RRSP. They think they're being conservative. They think they're preserving their assets. But what they may actually be doing is locking themselves into years of potentially higher taxes later on in retirement. Or they're too aggressive, starting already in a high tax bracket. They decide to take a bunch out. They jump brackets. They go over the OAS clawback limit. They pay dearly in opportunity cost. They think it's like ripping off a Band-Aid. Just get it done. Probably detrimental, especially if you haven't run the numbers. Here's what a proper RRSP meltdown can look like. You delay your CPP to age 70. That eliminates a taxable income stream for a portion of early retirement, and it also increases the amount you'll receive from CPP when it does start. It grows by 8.4% per year between 65 and 70, plus increases due to inflation, and that's significant. If you're delaying CPP, you draw more from your RIF, not recklessly. You're still staying within your tax bracket, but probably more than the minimum. You're melting down that RIF while your overall taxable income may be lower. In Margaret's case, the difference is significant. In the original plan, she takes reduced CPP at 60, takes the RIF minimum, and tops up with her TFSA. For her, that scenario results in a deficit of income beginning at age 88 because she's used up all her assets. In the revised plan, we delay her CPP to 70. We draw $36,000 per year from her RIF early on. At age 65, we ramp that up to $45,000 because of the tax credits that become available at that age. Then when her CPP starts at 70, we scale her RIF withdrawals back to about $24,000. Her RIF is basically depleted by age 87, but her TFSA still has funds. In this scenario, she begins a deficit at age 96. That's an extra 9 years of expenses and cushion created for Margaret. Same assets, different strategy. This is why the RRSP meltdown can work. You may be paying tax when your rates are lowest early in retirement before CPP starts, and you're preserving your TFSA for when you may really need it. We recently did an entire video on the tax breaks that become available when you turn 65. The age amount, pension income splitting, the pension income amount credit. If you haven't watched that, I'll link it in the description. But I want to mention it here because it ties directly into the strategies we've been talking about. At age 65, your tax situation can change significantly. Tax credits kick in that may help reduce your tax bill by thousands of dollars, even if your income stays the same or increases. A retiree's taxable income can actually go up from age 64 to 65, but their total tax paid can drop just because of the credits that become available at 65. So when you're planning your RRSP meltdown, when you're thinking about income splitting, when you're deciding when to start CPP, age 65 is a critical inflection point. It's not just about CPP eligibility. It's about potential tax efficiency. And if you're not structuring those withdrawals to take advantage of those credits, you may be leaving money on the table. These 5 strategies, income splitting, TFSA preservation, maintaining a level tax rate, the RRSP meltdown, and leveraging age 65 credits can collectively help reduce unnecessary taxes throughout your retirement. In some cases, these strategies can create substantial long-term savings over a 25 to 30-year retirement. But here's what you need to understand. Most of these strategies require advanced planning years in advance. You can't implement an RRSP meltdown the year you retire if you haven't considered spousal RRSPs. You can't income split effectively at all ages if your money is in one spouse's name. You can't preserve your TFSA if you've been drawing from it heavily for the first 10 years of retirement. And here's what concerns me. Every year you wait to address these strategies may be another year where you're potentially paying more tax than necessary. Taxes you won't get back. The CRA isn't going to call you and tell you, hey, there might be a better approach. Your bank isn't going to restructure withdrawals to help reduce your tax burden. This falls on you. And the difference between retirees who may be paying closer to the minimum tax and those who might be overpaying often isn't luck or income or net worth. It's planning, implementing, and reviewing a well-thought-out structure. If you're a Canadian retiree or within 5 to 10 years of retirement and you want a withdrawal strategy that may help minimize your taxes and maximize what stays in your pocket, click the link in the description to book a consultation. We'll review your specific situation and show you exactly how these strategies might apply to you. Because here's the reality. You can't watch this video, think that's interesting, and do nothing. And next year you may still be in the same position. Or you can take 30 minutes, book a consultation, and find out exactly what this might be costing you and what your options could look like. And if you want to dive deeper into retirement planning, make sure to download my free retirement guide. The link's in the description. Let's take the next step.